and welcome back to the last topic that we have over our inventory module, which is where we're talking about the lower of cost and what we call net realizable value. So what is net realizable value? Well, hey, how much am I going to get for this inventory? How much am I going to get from a selling price perspective? And what's my cost to sell? Okay, so I'll say sales price less cost to sell. What might some cost to sales be? It could be if you're paying shipping, right? You're shipping this and you're giving customers free shipping, different things like that. Okay. So why is this conversation important, right? What does this have to do with anything? Well, it's saying, okay, I recorded on my books my inventory purchases at cost, right? Say I'm using a perpetual system. I would have recorded inventory for the amount that I paid for it, right? As Mario GameStop, I had inventory for $1,700 and I have an accounts payable. Well, now the second type of this for gaming console came out, and nobody wants this inventory anymore. Okay, nobody wants the first edition of the game that I bought to sell. They want the second edition. So now I have this inventory sitting on my books, and I'm not going to be able to even get $1,700 for it. I'm not even going to be able to get what I paid for it. Okay. My cost has fell below my net realizable value. And that's a problem because again, this inventory, well, that's on my balance sheet as an asset. And we say that an asset is measured at its future economic use to me. Well, that tells me right there, think about what I just said. I'm not going to be able I don't have a resource of $1,700 anymore. I only have a resource of what my net realizable value is. So what that tells me is that I need to make an adjustment. I have to have an adjusting journal entry, okay? If my net realizable value falls below my cost. Now, hey, think about the other side of this. I have this inventory sitting on my books at $1,700. I'm going to be able to sell it for $3,000. That's fine. There's not any adjusting entry needed. It's just if the net realizable value falls below the cost of it. So again, that's why you're saying I need to have my inventory be on my books at either the lower of cost, what I paid for it, or net realizable value, NRV. So what does something like that look like? Okay, this is exactly what I was saying. We are Mario's GameStop, and it looks like we have inventory. We have the Fun Station 2. Okay. And it looks like the Fun Station 3 came out during the year. Okay. So the Fun Station 2, I have 15 of these products. I paid $300 for them. And I'm going to stop right there and I'm going to say, hey, I'm only going to be able to sell them for $200. Right off the bat, that's a problem to me because my net realizable value has fallen below my cost. So ask yourself, do I need an adjustment? Like, is an adjustment needed? Well, yes, for the Fun Station 2, it is. Why? Because over here, my cost is below my net realizable value. How much is my adjustment? Well, it's just the difference, okay? I have 4,500 of cost with a net realizable value of only 3,000. And again, I'm doing this for all of my products, not just one of the, or not just one, of the quantity here. So I have an adjustment needed of $1,500 from this Fun Station 2. Okay. Now I ask myself the same thing for Fun Station 3. Okay. I purchased this for $400. I'm going to be able to sell it for $450. Well, do I need an adjustment? Well, no, of course not, right? Because I'm going to be able to sell it for more than I paid for it. So it's on my books at the lower of cost and net realizable value already. So I don't need an adjustment. Why do I not need an adjustment? Because my cost, right, is, let me think about this, greater than my net realizable value. So the only adjustment that I need is for this $1,500 right here. So what accounts do you think are going to be impacted? What am I trying to accomplish? Well, number one, I'm trying to accomplish getting that inventory correctly stated on my books for 15 and decreasing it by 1,500. Okay. So then the other plug figure, or what I throw that through, is my cost of goods sold for 1,500 as well. So now I have recognized an expense in my income statement that's going to show that my inventory has decreased in value. I'm decreasing my net income, my profitability because of that. I paid too much for it. I shouldn't have paid that much. And I'm reducing my inventory to get it stated at the lower of cost and net realizable value. So if you think about what this inventory it looks like specifically for my Fund Station 2, well, I started with 4,500. I have hit that account by 1,500. So now inventory is stated on my books at 3,000, which matches my net realizable value. Okay. So at the end of the year, a company reports the following inventory accounts per unit. The amount to report for ending inventory. Okay. So again, now we got to be cognizant. Am I calculating ending inventory? How much needs to be on my books? Or am I calculating my adjustment? Because those two things are different. So in this case, we're supposed to calculate my ending inventory amount. So do I need an adjustment for A? It cost me $4. I'm going to be able to sell it for $8. I have no adjustment needed. So what does that mean? What is my inventory on my books for? Well, my inventory is on my books already at cost. So I have inventory on my books, right, at 100 times 4, which is $400. Now on item B, I have 150 items. It cost me $8. I'm only going to be able to sell it or have a net realizable value of 6. Do I need an adjustment? Well, yeah, I do. So that adjustment is going to reduce my inventory so that it's going to be stated on my books at net realizable value. So make sure you can book the adjustment. But for this question, all I need to do is have 150 units on my books at $6, my net realizable value. Okay. Which is going to give me, oh geez, let me see if I can grab my calculator quick. One of my favorite things is when people are like, oh, you're an accountant, you must be great at math. And I rely very heavily on a calculator and or Excel. So 150 times 6 gives me $900. So that tells me inventory is going to be on my books for 1,300. Okay. So what's the other side of that transaction? Well, of course, it's going to be that adjustment. Okay. Because we know I have to have an adjustment. So I've already calculated my ending inventory. Well, what is my adjustment? Well, my adjustment is saying I need to get item B stated on my books at $6. It's on my books at 8. So I'm going to have 150 units multiplied by my cost less my net realizable value. So an adjustment of $2 per unit is going to get that inventory stated on my books at $6. So I have an adjustment of 300 needed. Well, now I have to know, how do I book that journal entry? Well, all I need to do is what? Number one, I'm trying to reduce my inventory. Start with what you know. And in order to reduce my inventory, I credit my balance by 300. What else am I going to do? Well, I'm going to say, hey, I probably made kind of a bad business decision and I'm going to lose money on this. I have to recognize an expense. And I recognize the expense of 300 as well. So now I just need to find where I have a debit to cost of goods sold of 300, or I have a credit to inventory of 300, which is this A right here. Because fundamental to this, why do we do this? Because our assets need to be stated at the future use that we're going to get out of them. So just remember, kind of to sum up the chapter, not every company has inventory. That's totally okay. It's just what do you do in your ordinary course of business? Then ask yourself, am I using LIFO, FIFO, or weighted average cost? Am I using a perpetual or a periodic system? What journal entries do I need to book? When do I book those journal entries? And then at the end, I come and I say, well, hey, is what's on my books for inventory accurate, or has the net realizable value gone down? So as always, please let me know if you have any questions. Otherwise, enjoy the rest of your day, and I will see you guys next chapter, chapter 7, where we talk about long-term assets and property, plant, and equipment. So I will see you then. Bye-bye.